Hey guys, it is Julie here with JT Wealth. In today's video, we are taking a look at two stocks that are rated strong buys and Goldman analysts think could grow over 30%. So let's get into it. All right, guys, welcome back and thank you so much for being here. In the US today, the market is closed and where I am, we're in the middle of a snowstorm. But I have my hot toddy ready to go and we're still gonna look at some growth stocks for the week ahead. Specifically, we're gonna look at two strong buy stocks that could surge at least 30%. So in today's video, we're going to take a look at two companies, what they do, and why analysts think they are positioned for some great future growth. And just before we get into that, this is your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button and leave your thoughts in the comments down below. Also, don't forget to check out some of the great links in our description, which includes my favorite resource, TipRanks. Now, their free plan has a ton of helpful information, but the ultimate and premium plans come with some incredible tools. So if you're thinking about signing up, make sure you use that link down below to let them know I sent you. The first company that we're taking a look at today is Stellantis. And Stellantis trades under the ticker STLA and closed last week at $16.20 per share. Stellantis is at the forefront of a new era in sustainable mobility. Their mission is to provide freedom of movement for all through distinctive, appealing, affordable, and sustainable mobility solutions. Their company's strength lies in their breadth of iconic brand portfolio, the diversity and passion of their 400,000 people, and deep roots in the communities in which they operate. Now, Stellantis is actually a fairly new name to the market, as it is the result of the merger of France's PSA and US Italian rival Fiat Chrysler, who just merged back in this January to create Stellantis, which is now the world's fourth biggest automaker by volume. So under the Stellantis umbrella is some very well-known automobile names from Chrysler, Dodge, Ram, Jeep, Maserati, and more. Matthias Heck of Moody's sees the merger as a good thing for both the French and Italian makers because it'll improve their global coverage. They can collaborate at the technological level and in various segments will save money through the synergies and experience of PSA, which has been able to set the right price and manage its costs. The deal that formed Stellantis took 16 months to accomplish, and now that it is a reality, the combined entity promises cost savings of nearly 5 billion euros in the operations of both Fiat Chrysler and PSA. These savings look to be realized through greater efficiency and not through plant closures and cutbacks. Now, if you regularly watch my videos, the name Stellantis might be ringing a tiny bell, and that is because they were recently mentioned in one of my videos regarding Archer Aviation and their latest SPAC deal. And that is because Stellantis is partnering up with Archer to help produce their all-electric airline. So Archer will be able to access Stellantis' supply chain, advanced composites, and engineering and design experience, allowing them to move more quickly towards their final goal in a much more cost-effective way. One analyst covering the Stellantis stock for Goldman Sachs is George Galliers, and he is upbeat on their future, writing, "We see 4 drivers which in our view will enable Stellantis to deliver. PSA and FSA's product portfolios in Europe cover similar segment sizes at similar price points. There's incremental economies of scale that can potentially have material impact on both companies, and both companies are at a relatively nascent stage in electric vehicle programs. The merger will prevent duplication and deliver synergies. Finally, we see some opportunities around central staffing where existing functions can likely be consolidated." With that, he rates the stock a buy with a $22 price target, which would be nearly a 36% potential upside. And there are 6 other analysts that have current ratings on the Stellantis stock. And it comes in as a strong buy, with all 7 analysts rating it a buy and an average price target of $21.58 for a 33% potential upside over this next year. We do have one older price target from 3 months ago down at $15, which has a negative potential there, but all the more recent ones within this last month since the merger was completed are well above that $20 price point. The highest one coming in at $22.43 for a 38.48% potential upside. The second company that we're taking a closer look at today is NRG Energy. They trade under the ticker NRG, and as of close last Friday are at $43.04 per share. NRG is working on a plan for a new electric future by using diverse generation sources and leaning on new digital technologies and management tools. They're evolving the power market to become smarter, more sustainable, and more reliable for businesses and residents across the country. NRG is a $10 billion utility provider with dual head offices in Texas and New Jersey. The company provides electricity to more than 3 million customers in 10 states plus DC and boasts over a 23,000 megawatt generating capacity, making it one of North America's largest power utilities. NRG's production includes coal, oil, and nuclear power plants, plus wind and solar farms. And their renewable energy sector is starting to gain some traction, as Empire State Realty Trust has signed a 3-year contract with NRG Energy's subsidiary Green Mountain Energy that will expand the power sourcing for Empire State's portfolio into 100% renewable wind energy. The contract will enable Empire State to purchase more than 300 million kilowatt hours of renewable energy to power its office property portfolio, which covers more than 10.1 million square feet in Manhattan and the suburban Westchester and Connecticut markets. Covering this stock for Goldman Sachs is analyst Michael Lapides, and he notes the recent acquisition of Direct Energy this past summer, saying that he expects the company to deleverage itself in the near term. After NRG's acquisition of Direct Energy, one of the larger electricity and natural gas competitive retailers in the U.S., we view NRG's business as somewhat transformed. The integrated business model, owning wholesale merchant power generation that supplies electricity that gets used to serve customers supplied by NRG's competitive retail arm, reduces exposure to merchant power markets and commodity prices while increasing FCF potential. He says, we view 2021 from a capital allocation perspective as a deleveraging year, but with NRG creating almost $2 billion a year in FCF, we see a pickup in share buybacks as well as an 8% dividend growth ahead in 2022 to 23. He rates the stock a buy with a $57 price target, which would be about a 32% potential growth over the next year. Now, there are 4 analyst ratings altogether on this stock, and it comes in as a strong buy with 3 buy ratings and 1 hold. The average price target is $52.75, which would be just over a 22% potential upside. The lowest price target is obviously that hold rating at $45 per share, which is still a 4.5% potential upside, and there are 2 ratings at the $57 price point for that 32% potential upside. So there we have 2 stocks that analysts think have room to grow over this next year. Now, you guys know I always love hearing from you, so make sure to leave your thoughts on these 2 companies in the comments down below, plus what other stocks you are looking at for growth lately. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes to bring some new companies to your attention and on your radar that you can then go and do further research and due diligence on before making any investment decision. If you made it all the way to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. I hope you guys all have a fantastic day. Thank you so much for watching, and cheers.